Okay, so now we're going to do a premium bond using the effective interest method. This one's going to be a little bit different, and you're going to see that sort of in the description here. First of all, we can see that it is a 3-year semi-annual bond, means that interest is paid semi-annually. And also you're going to notice that the bond was issued on May 1st, 2020, which does not coincide with the December 31st fiscal year end. And so that's going to create a few extra journal entries and a few things to consider. And so we're going to walk carefully through that. And of course, this one is being issued at 103, which means it's being issued at a premium. And so we're going to do some journal entries, all of those for 2020, the April 30th, 2021 journal entry, and then finally the final journal entry on 4/30/2023. All right, for the issue price, we can see again you apply the price 103, which is 103%. We apply that to the par value, meaning the issue price is $360,500. And so with the initial journal entry on May 1st, 2020, we can see that the cash proceeds were $360,500. The par value for the bond payable is $350,000, which means that the premium on bonds payable is $10,500. Again, this would not be any different for a bond if we were using the straight line method, but everything after this is specific to the effective interest method. Okay, so we do have the issue price. We also calculate the interest payment. The 7% bond rate is the annual rate, and so those payments are made semi-annually, and so that's where we get the 3.5%, and we apply that 3.5% to the par value of $350,000, which means that every interest payment is $12,250. So now we're going to use our time value of money in order to calculate the bond yield, because we're going to need that bond yield in order to create our amortization table. The N is 6 because it is 6 semi-annual periods. The present value of the bond is the cash proceeds. The payment is a contractual interest payment. And then finally, the par value is the FV, the amount that's going to be paid at the end of the bond's life. Then we solve and we get the yield of 2.9472%. Again, because this bond is at a premium, we would expect that the interest payment or the bond rate, the semi-annual bond rate, should be more than the bond yield. And we see that where the semi-annual bond rate is 3.5%, but the bond yield is 2.9472%. So this is consistent with a premium bond. So now we're going to create our amortization table, sort of following what we showed with the discount bond. The expense is always the bond yield times the previous carrying value, and then the amortization is the difference between the interest expense and the interest payment. So we have the initial portion of the table, which is the issue date and the issue price. The carrying value is that initial issue price. Then 6 months pass and the interest payment is $12,250. The interest expense is that calculated bond yield of 2.94, I think 72%, times that initial carrying value, and that gets us our interest expense. Now in this case, notice that the amortization is negative, and the reason why it's negative is because the carrying value is at a premium, so it's going to go from $360,500 down to the par value of $350,000. Another way to think about it is that the interest expense is sort of what's economically owed, and of course we're paying more. That interest payment is more than what's economically owed. Therefore, essentially, in theory, you're paying down that liability. So we complete the rest of the table following that same process. The interest payment is fixed. The interest expense is the bond yield times the previous carrying value. The amortization is the difference between the two. And of course, we end up at the par value at the end of the day. Notice that the interest expense is getting smaller in this case, but since the interest expense is less than the payment, as the interest expense gets smaller, the amount of amortization gets bigger. And so amortization is increasing over the life of the bond, just like it was increasing over the life of the discount bond. All right, so now we're going to use the information from the table to do our journal entries. The first journal entry, of course, is the 10/31/2020 interest payment, and we can see that the interest expense is taken from the table, 10,625. The cash payment is also taken from the table, 12,250, and the premium, the amortization of the premium is the difference of 1,625, and that number also, of course, can be found in the table. So essentially, if you do the table correctly, the journal entry should be fairly straightforward. The difference, though, is when you come to that first fiscal year end, 12/31/2020. And the reason why it's a little bit difficult is because the amortization table is built around the interest payment dates. It doesn't take into account, nor should it ever take into account, the fiscal year end. However, we do need to accrue interest expense, and we also need to accrue the interest that is owed at the end of the fiscal year. When there is time between the last interest payment and the fiscal year end, you do need to accrue. You need to make an adjusting entry for the interest expense that's been incurred since the last interest payment. And so in this case, the accrued interest payment, the amount of interest that's owed, this is the interest payable, is the contractual interest payment, 12,250, times 2/6, because 2 months have passed since October 31st and the 12/31/2020 fiscal year end, for a total of $4,083. We also have to accrue the interest expense, which of course is based on the $10,577, also multiplied by 2/6, which means we accrue interest expense of $3,526. So our journal entry includes those two pieces of information that we calculated, the interest expense and the interest payable. And then we amortize the bond premium for the difference between the two. Absent any rounding, we could also take the amortization amount, 1,673, and multiply it by 2/6 and arrive at that same number. So then on April 30th, 2021, we have to complete the journal entry for the next payment. And so the remaining interest expense is the total interest expense, 10,577, minus the amount of interest expense that we previously accrued. And so the interest expense that was incurred from January 1st, 2021 through April 30th, 2021 is $7,051. And so now we have our journal entry. We have the previously accrued interest payable. And of course, with this interest payment, that payable comes off of our books. We have the new interest expense, $7,051. And of course, we also have the credit to cash, which is the contractual interest payment. The difference then is the amortization of the bond premium. Of course, we could also get that number by taking 1,673 from the table above and subtracting the previous amount that we had accrued, which I believe was $557. So we continue to do that process. Of course, in this problem, we're just going to jump down to the final journal entry, the April 30th, 2023 journal entry. So you have to use your imagination a bit and think about, okay, what would the journal entry have looked like on 12/31/2022? And we're going to use that information to understand what the journal entry should be for April 30th, 2023. Of course, the first thing we'd have to think about was that there would have been previous interest, accrued interest payable. They would have recorded 12,250 times 2/6, or that same $4,083 of accrued interest. So we would have recorded that on 12/31/2022. We also have to understand that some of the interest expense would have been recorded on 12/31/2022, which means that only 4/6 of the interest expense should be recorded on April 30th, 2023. So we take the total interest expense, 10,371, multiply it by 4/6, which gives us our accrued interest expense for April 30th, 2023. So we're going to take that information and put it into our journal entry, along with some extra information, of course, as well. But we have the interest payable and the interest expense. We can see that the bond payable, of course, it's being paid off. So we're going to take that off of our books at the par value. And the cash, of course, reflects both the final interest payment of $12,250 and paying off the bond payable, $350,000. And so the amortization of the bond premium is the difference between the two. Of course, we could also take 1,879, and we could multiply that by 4/6, and we approximately get $1,253 absent any rounding.